Morning all. How are we all doing? Happy Monday. Back again. Morning Steve, JC, Peter, Harold, David, John, Amy, Christian, Danny, Burke, Mimpo. Morning, Howie. How are you? Mimpo Cybertron. That's a really good name. Back from vacation in Colombia. Missed us all. Colombia? What are you going to Colombia for? Isn't that where they grow all the naughty drugs? Morning, Kennelly. Right, let's have a look at what's going on. I was just quickly having a look at the DAX before the news. We've got a lot of gaps to the DAX, to the upside on the DAX. Father is Colombian. Okay, I'll let you off then. We've got a lot of gaps to the upside. So there's a big gap from Friday. We've got that one from sort of Thursday, which is debatable whether that's a fill or not. That's done. We've got a big one there as well, debatable again. And then we got this one from up there. So there's potentially sort of 3 or 4 upside gaps, basically. We know the market doesn't like to leave them in place for more than a week or so, usually. Sometimes it does, depends on what's happening with the market, obviously. There's no adverse reaction to Russia. Obviously, we had everything kicking off in Russia over the weekend. Market doesn't seem to have batted an eyelid to that. It would usually gap dramatically if there was going to be a run for safe havens. There hasn't been. So we have to keep an eye on the news, though, this week, because any kind of potential coup in Russia or takeover attempt is obviously going to have an impact on the markets. They will try and get money into safe havens, probably. So we'll see. Also, if that does progress in Russia and it scales back the conflict, that will have an impact on gold prices, because a lot of the gold export bans we've got on will potentially start to be removed at some point. So that's a long way off yet. Right, so there's DAX, lots of upside gaps to target. News over the weekend, main news. So this is starting overnight from here. FX. Japanese FX diplomat Kanda, we will respond to FX moves if they become excessive. FX should fluctuate steadily in line with fundamentals. We are focusing on FX moves rather than levels. So that bit there, where we've quite often talked in the past before interventions about levels, what they're saying here is they're focusing on the moves rather than the levels. So I think what they're looking at more is aggressive moves against them, rather than if you get to 145 on the US dollar, we're not going to be happy about it. So I think they're looking, obviously, for any sharp moves against. So we'll see what happens with the FX markets with Japan this week, but they are still talking about intervention. So hasn't gone away. It's still there, because we did have some movement negative on Japan on Friday. So apart from that, there wasn't an awful lot else apart from Suzuka backing it up. Look, we will continue to monitor the FX market with vigilance. So short everything against the yen. Apart from that, no other news. So everything else we got this week is starting tomorrow, basically. So today we've got the IFO Business Climate coming out at 9. We've got Jordan speaking at 9:50 and Lagarde this evening. Main news kicks off tomorrow with CPI figures. So the inflation figures for the Canadian dollar at 1:30. Then we've got consumer confidence for the US. Australian inflation on Wednesday morning, followed by Lagarde and Bailey and Ueda and Powell, all at 2:30 at market open in the US. That's going to be a fun one. So yeah, Wednesday US session, I'll probably leave it. Then we've got the CPI for Germany and the GDP for the US and unemployment claims, followed by the GDP for Canada and the PCE on Friday. So it's not a massive week, but it is inflation week. So obviously inflation is the core driver for interest rates. When we get these coming out, they do have a big impact on the market. So we have got big market moving events. So tomorrow is Canada, Australia on Wednesday, Euro on Thursday. We've got Japan on Friday, but their CPI won't do much. So all Tuesday, Wednesday, Thursday this week for news. How long we got left? 2 minutes. There's no ADRs so far this morning, so the market's been fairly quiet during Asia. Nothing hit ADRs. Obviously, there's nothing on the weeklies because it's the beginning of the week. There's quite a few monthlies. I mean, we've been looking at these all week, or all month, basically. We know what's going on. The yen is being squeezed to death. The Australian's been pumping like a crazy thing. So everything else, basically, is pretty much business as usual. It's just obviously the Aussies and the Yens which have been the key drivers. So there's nothing to look at on ADRs. There's quite a few RSIs. We'll have a look through these RSIs in a minute, but we'll wait for the market to open and watch the DAX and see how that gets on. Morning, everybody else. Steve, Jerry, Virginia, Philip, Monkey, Evil, how are we all doing? 2 minutes to go. So I haven't done a lot over the weekend. I've done some more back testing over the weekend on the new opening range breakout, clever version, if you like. So I've done a big back test. For some reason, my spreadsheet doesn't want to open. There it is. Done 1,900 parameter permutations. I don't know if I've got them all in, actually. So 1,900 tests this weekend. 1,500 profitable. Not bad, but so some very small drawdowns, which is interesting. So and lots of different numbers of trades as well. So some of these tests running from 400 trades in a year up to 800 trades in a year, depending on ranges for pre-market opens and stuff. So I've got to go through all this data this week. But a lot of profitable stuff in there. I mean, some massive return on drawdowns. So all looking good. I'll update you on that during the week. Morning, Mr. Lunary, Stevie. Right, market's about to open. So opening range breakout this morning on the DAX. Not going to get on the pre-market. Well, I'm not going to get on the pre-market with this version of the EA. We're sitting up at these highs at the minute as well. So this is a pretty resistive area. Very close to the high. 11 seconds to go. So there's your 15-minute pre-market. There's your 5-minute pre-market. Very, very tight today on the 5-minute pre-market. And we're up at a resistance. So this thing could well go out the gates. So yeah, so this is a prime example of why I'm using this new variation of the EA to test what the best ranges to take are. So that pre-market 5 today, the range was too small, the candle was too close to the high, and basically what you've done is you've gone long, you've gone short, you've stopped out basically on everything. So total whipsaw at the open. So these pre-market ranges, my testing is showing that you are much more successful when the 5-minute candle closes somewhere nicely inside the range, not at the high of the range. My testing is also showing that if this is a very small candle, the chances of whipsawing are way more than 50%. So you go with an immediate 2-hour loss if you've got a small candle. So the idea of testing this is to see which range works, if any. But if it's that high and that close to the close of that 5-minute candle, it's just not worth taking. Wait. Give the market time to open and take the original 5-minute opening range break. We know that is profitable long term. That's got a huge edge. So these are the really aggressive ones, these pre-market moves. And they're massively profitable when they work, as we know. But when they don't work, they hurt. So basically the EA this morning, this version, so the first range is 70. So the minimum range I want to see is 133. The second range is 135, so that was big enough. However, the distance from there to the top of the range was nothing, so it didn't take it. So it skips all the pre-market trades and waits for the opening range breakout. So, well, then now it's going to basically measure the distance of that, see if that's not too big. Again, if that's over 20% of the average daily range, which sometimes it can be, we'll just skip it, move on. Because again, 20% of the average daily range, if more than that is put in one candle on that 5-minute open, that cash balance, most of the time, the market hasn't got enough energy to do a trend. So we'll see. But if you're taking the original 5-minute opening range breakout anyway, you'll be waiting. Look at the size of that. I mean, it's a huge move on the DAX. So 15-minute pre-market, you've gone long, stopped out, flipped short. Danger here is obviously pulling back into there and stopping out in that second position. Anyway, morning outro, all good. All good in here. So 2 minutes to the close of this candle. It's a big range that. So ADR on this is 151. That's 30 points. So it's nearly a quarter of an ADR. So the maximum, which is a quarter of an ADR, a fifth of an ADR, rather, is 334. So if this candle puts in more than 334, won't be interested in taking a break today. It looks huge when you look at it in that. It's a lot smaller there, isn't it? Same candle. Different perspective. So we're just testing this propulsion gap at the moment, which we've rallied into. So target-wise today on the DAX, if we're going short, obviously last week's low is the obvious spot, which is ADR today. We've got this area here, which is the previous day's low, which we tapped into at the open on Friday. And then we slammed through it, came straight back up again and held. So there is a little bit of resistance there, but that's kind of invalidated now. So I would say probably last week's low, which is Friday's low, would be your downside target to watch for a bounce. Upside, obviously, we've got the gap fill to do. So Friday's high isn't far away. But if we're going to go for that gap fill is probably what I would suggest is probably the best target, which is pretty much ADR to the upside. But they certainly look like they want to be selling it off this morning, don't they? Let's quickly look at what the other indices are up to as well. All selling off something. They're selling something off this morning. Okay, so there's your 5-minute range. So that is opening range size is 40 points. 33 points is what I class to be big, which is 1/5 of an ADR. So this version of the EA hasn't taken any trades this morning. However, if you're taking the 5-minute ORB, there it is. Moving it. So this is what I mean with the problem with the opening range breakout when the candles are this big. It's got to put some serious selling strength in now to actually get a break and to actually get a 1.5 hour return on this. And this is the whole purpose of my testing. To get 1.5 hour on that opening range break. So there you are, you're short 5-minute. You've got to get all the way down there. Yeah, so you see ADR is there. So, you know, even if you just wanted to get a 2R, that's pretty much the entire average daily range to get a 2R return. The risk reward isn't there. When the candle's that big at the open, the risk reward on that 5-minute break is a lot worse. It's a lot more difficult to actually make money out of it, isn't it? So the risk profile is too high. So 1.5 hour, you're not going to get candles of that sort of size going in all the time. So it's going to be kind of that sort of price action. So to get to 1.5 hour, you're probably sitting it for 2 hours. Just not worth it. Skip it. Wait for the afternoon. Right, let's have a look at the RSIs. First day back off holiday. Finally, a decent pre-market 5. Been testing taking profits at 1.5 hour and results looking good so far. You got that, did you? Did you not get whipsawed? Is that not a whipsaw? Stop out. If you didn't get stopped out on it, obviously, yeah, that was a massive risk reward. There's a lot of times, obviously, in my testing, when I've been testing this 5-minute pre, where you don't obviously get, well, even if it's a tiny little range, you get it on, and yeah, I mean, that's a massive reward, isn't it? So that's 5R on that opening range, that 5-minute. Fairly good. You took it and you didn't get whipsawed. Morning, Potgaiter. Right, RSIs. So Australian dollar. So the main focus, obviously, as you can see, is the yen and the Australian dollar. So everything we've got to look at today is Australian dollar and yen based. Let's actually quickly, before we do the RSIs, let's quickly look at oil. So the trade from last week that I was in, from here, actually the previous week, that I got out of on Wednesday last week, all right, Thursday last week, it came back. So if you had put a break even on that, they took you out on Friday. So very glad I got that 4R on that. But it's bounced again off of this level. So on Friday, we had another bounce. Yeah, so this level here, yeah, we bounced again. So this range is contracting. We are definitely contracting, and we are definitely holding this level. So this is a descending wedge. So it's much more bearish than bullish, obviously, at the moment. So it's not something I'm interested in getting into at the minute. But it does confirm the fact that these oil prices really are not going to hit these targets that have been set by the institutions this year. So the institutions are talking $95 a barrel. Why are you not zooming out? $95 a barrel reduced from 107 a barrel. Yeah, so that's what they reduced the target to, which is basically this peak here. It's not getting anywhere near it. So it doesn't seem to be able to recover. However, they do not seem to be reducing the price either. So we will get to the point where you can't keep doing that, because eventually there's no room. So you have to break one way or the other. It's kind of the same as a symmetrical triangle break. It's a descending wedge. So if this breaks to the downside, it's very, very difficult to look at where we're potentially going on oil. Obviously, if everything escalates in Ukraine, oil pricing will rise, because anything escalation-wise with war requires an awful lot more resources, oil being one of them. So oil prices tend to rise during conflict, a la Ukraine war starting there. But other than that, oil is declining, and the demand for it is declining as well. So we're in a really tricky spot here. When we do break this low, if we do break this low, this thing I think is probably going to fall out of bed very, very quick. Sort of we're off for a while. If it doesn't break that low and manage to actually try and rally up to the highs, obviously, I don't think we're going to get much more above 80 to 83 a barrel before we just get stuck into some kind of range, which is pretty much what we're doing at the moment and have been doing, if you look, since November. So it's a good spot to buy, but you need to have a stop on this down here. If it comes under this level, under 125 ADR, you're stuffed. And upside target wise, I think you're going to find it very hard to make any money on it. So I think oil at the moment, unless you're scalping on 5-minute, it's just not worth bothering with. It's just not got a big enough range. That was this trade that I got into there was incredibly lucky that we got that bounce. Obviously, always is lucky, but didn't get to target. So if you think about how this is descending at the moment, obviously we're putting in a high, a low, a lower high, higher low. And then we put in a double top there. So basically the market structure on it is high, low, high, double bottom, low, double bottom, low, double bottom, or high rather. So every single high that we're putting in is getting lower and lower and lower. So if you're going to trade this long at the moment, you don't want to be looking any more than sort of that propulsion gap, because if it's going to continue to do what it's going to do, it's going to put in a lower high. Then we're going to come and retest this level again. And there's only so many times you can knock on the door before the hinges come off. When they come off, going down. So just be careful if you are trying to long that thing, and just obviously use a stop with it. It's not for position trading. Gold basically broke out the lows as well. So US dollar strength started to come through last week. I'm not convinced it's going to be sustained. So we've got a new weekly low put in just down at ADR there. Job now is to try and break through this level of previous support, which was very strong. We've now got to try and crack through that if we're going to go long, which means we're going to need a weak US dollar. And we got some strength finally. So gold again, very, very tricky. We're just coming out of a range, which we've been in for absolutely ages. And again, it's exactly the same pattern. Descending wedge, basically. We've finally broken out of it. We've used the previous resistance, or rather support here, as resistance. So if we test that level again, that would be a beautiful short. This propulsion gap should hold, I think, and then go down. So potentially we're looking at some US dollar strength, which means indices potentially should be looking for shorts as well. So so now we've covered the commodities. The reason I'm just looking, yeah, we have got a CAD in there. The reason I just wanted to cover oil was because obviously we've got the Canadian dollar to look at. So so starting off with Aussie dollar CAD, obviously this thing's coming down like an absolute crazy thing at the minute. So that A-shaped recovery now is complete. So beautiful A-shaped recovery on it. Aussie dollar getting absolutely trounced by the Canadian dollar, even with the price of oil reducing. So this is a great spot to be looking to buy it. We're extended on the hourly and we're extended on the 4 hourly. So massively extended. So we're down below the 20 level. Again, 20 level we don't get very often. Let me just move that down actually. And let's move that up to the 80. So the 80-20 level on the H4 is kind of the sweet spot at the moment. We haven't been out of these lows down here for absolutely ages, for a good 6 months, this year basically. So yeah, it looks like a beautiful buy, doesn't it? We've got a double top put in there, or triple top if you like. And now we've got a double bottom. There's been no profit take move whatsoever on that drop. So they are going to pull back on that at some point. Where to, obviously, we need to have a look at, but 50% of it is a typical pullback if you're going to continue on a downward leg. If we're going to go into a range, it doesn't matter. It's going to go up, isn't it? So so that's a really good buy at the moment, Aussie dollar CAD. Fundamentals this week, you just need to be aware of, obviously. We've got the inflation figures on Wednesday and we've got the inflation figures tomorrow. So the Aussie dollar CAD is going to be affected tomorrow and on Wednesday. So the ideal, if you're going to take a long on this, obviously, is that we get inflation coming down on the Canadian dollar and inflation going up on the Australian dollar. That would be a perfect scenario, because obviously the Aussie dollar CAD will just get double whammy and you'll get 200-300 ADR move in 2 days, which would be fantastic. So at the moment, though, it is selling off hard, as you can see. So it's just continuously selling off. There is absolutely no strength whatsoever in this Australian dollar at the moment. Yeah, it's coming down very, very hard, as we would expect, because it's been squeezing like a crazy beast, hasn't it? So this is the pullback or the profit take move, if you like, on the interest rate rises that we had for the Australian dollar. So they're just basically taking profit on it. But everything else is sort of powered up while they've been taking profit. And obviously the Aussies really not benefited from that at all. So Aussie dollar CAD massively extended. Aussie dollar Swiss propulsion gap just filled on that one. So again, this is a 50% retracement. If we're going to go for a new leg up, which is going to require the euro and the Swiss franc to weaken, that's where you'll be looking to buy it from. But that's not quite extended on the hourly. 4 hourly, we're just coming out of an extension. So again, market structure has shifted back to the upside. So we're looking for buys at some point there if we're going to continue on that. But again, Aussie dollar, no reason why it should be particularly strong. If you look at the bias scorecard at the moment for the Aussies, they're all sells. Yeah, this is what I mean. We've had this period of, and there's no reason why it shouldn't continue. There's no reason why it should be there in the first place. But we've had this period of the market doing completely the opposite of what you would typically expect off of fundamentals, haven't we? So the Aussie dollar is a sell against the Swiss franc, the CAD, the New Zealand, and the US. However, it's been massively squeezed on a rally to the upside. So market at the moment, especially with the US dollar, massively short. Retail are longing the crap out of it. Yeah, so it's still a short. So, I mean, everything is basically a short on the Aussie dollar. And Aussie dollar yen is obviously a short, but that's really because we're expecting the yen intervention, not so much for any other reason. But so, yeah, shouldn't be strong really on the Australian dollar. We should be looking for sells everywhere, ideally. So it is nicely extended to the downside at the moment, but it has also broken structure to the upside. So there is potential for that move. But it's nice and orderly, Aussie dollar Swiss. Always will be, because the Swiss franc will power up massively whenever it wants to, and you always get out of it. Aussie dollar New Zealand dollar, our friend that squeezed the crap out of me after the New Zealand interest rates went completely the wrong direction. Completely undone. So if you were in it and you hadn't taken any aggressive drawdown control positions, you're out of it now. So it was a squeeze. It was a month, but you're out. So Aussie dollar, New Zealand dollar is all complete. Now looking for opportunities to buy it. Very difficult to decide where we are at the moment. We're bang in the middle of a range. So could go either way. I would suspect there's a good opportunity for us to do an A-shaped recovery in exactly the same way as they have with the Aussie dollar CAD. So move like that, basically. There's no reason why that Aussie dollar should have been as strong, and there's no reason why that New Zealand dollar should have been as weak. So it was just, this is what the market does. It will squeeze and it will squeeze and it will squeeze and it will keep squeezing until nobody's left to go short on it. And then it will go, fine, we'll undo it. Bang. And then you get that, obviously, snapback. Again, going back to the Bootcamp, this is the elastic band theory. The more stretch this gets, the faster, the quicker that snapback becomes. Yeah, 50% retracement is very typical. So Aussie dollar, New Zealand dollar. So you could be looking for longs here. It's had a big reaction this morning in the last hour. Big bounce off of this area here. This is a 50% retracement. So all the fib traders are buying this up at the moment. Not quite, actually. It's 38. 50 is ADR, basically. So that'd be a good spot. So if you're going to continue long on it, it's a good spot, obviously, to get in this morning on the hourly. You can see there's a buy on it already. Yeah, perfect. But still not sure about the bias on it, really. The Aussie dollar, New Zealand dollar is one of those pairs where the bias really doesn't mean an awful lot. The Australian dollar will always be in control if there is a reason, because it's the bigger economy of the two. They're close trade partners. They both deal with China. The Aussie will always win. However, the fundamentals between those two at the moment, if you look at the New Zealand dollar rates being on 5.5 and the Aussie on 4.1, the New Zealand's got the upper hand at the moment, which is why I was so surprised about that squeeze, because that is totally opposite to fundamentals. That move there was not right on a 5.5 interest rate. Everybody should be piling the money into the New Zealand, not out of it. So something weird happened there, but anyway, it's undone. So which way it goes from here, kind of that is what I would expect. So if you are going to buy it up here, we could get into the opposite squeeze here, couldn't we, really? But so just be a little careful with the Aussie New Zealand. But it's had its squeeze. It's unlikely it's going to do another one. You don't tend to find you get a squeeze followed by a squeeze. That's well, I've not experienced it before. So so you should be okay on it now. Buy it or sell it, really, but it is more of a short than a long. So this is kind of current, obviously, as you can see, counter trend pullback. So what we'll be looking for, if that's going to continue, something like that. In fact, I need to put a TP on it. So go for that propulsion, basically ADR. Aussie US. So again, all I'm unraveling. There's a buy on that one as well. It's been taken this morning. Three-quarters of an ADR, basically. That propulsion gap there. So there's a propulsion gap there. So I'd look to target that one just to get out there, which is basically underneath this support. Aussie US, so that's extended on the hourly on Friday. First entry was there, as you can see. So we had the 5-minute reversal alert on Friday. In there somewhere. Yeah, just look for some kind of pullback up into, that's the previous day's low. So somewhere up around ADR as a target. Nicely extended. 5-minute reversal alert has just gone in this morning as well. So there's an entry signal this morning you've just had on that one. 2 on the 4-hour, that one is extended, just come out of extension now. So Aussie US really is just coming out of extension, but again, this is a 50% retracement on that move. Again, all the Aussie squeeze, as you can see, got out of that one on last week there way too early. Could have got loads more out of it, but not what it's about. It's not about getting the glory trades, it's about getting out with a profit. So Aussie US, potentially good long opportunity. However, with the strength that we've had on this US dollar, difficult to tell if it's going to continue. There's not a massive amount of US news this week that's going to trigger anything. So that massive 4-hour propulsion gap obviously is a good target to the upside. CAD yen. So looking at the yens. So all the yens, as we know, are extended to hell. No different to last week or the week before or the week before. They are getting squeezed badly, which is why we're getting the talk about intervention. Oh, here we go. Just had some this morning. Again, so this is the 3rd time this morning they have said this. 3 different people. So we've now got Chief Cabinet Secretary Matsuno. It's important FX move stability, reflecting economic fundamentals. We're closely watching FX move with a high sense of urgency. Sudden and one-sided moves have been seen in the FX market. Right, so that sudden and one-sided moves have been seen in the FX market goes back to what we've just heard this morning from Kanda. We are focusing on FX movements rather than levels. Moves, not levels. Yeah. So he's saying we're not interested in people doing that against us at the moment. We're not worried about what level it goes to. We just don't want it to go fast and hard. He's just come out this morning and said, we've just seen a fast and hard move. So just watch these yens. This could happen any moment. 300, 500 ADR straight down, everything again. It's the yen. So I'm short everything yen, basically, against the yen. So I'm longing the yen, basically. When it goes, it's going to go. It's going to go fast. So just wait. It might not happen. Yeah. So again, somebody DM'd me about this over the weekend. When's the yen going to move? I don't know. I haven't got a crystal ball. But going historically, at any moment in time, it will just go mental. It doesn't have to do it, though. I think I've been... I haven't been misleading people. People have been misunderstanding what I'm saying. I'm talking about this intervention coming in the yen because we have interventions regularly in the yen because they say things like this. And every time they say things like this, suddenly the Japanese yen powers up massively. It's an intervention on the Bank of Japan's part to make sure their currency is kept stable and strong. It doesn't mean it's going to happen because they're talking about it. It's like warning. If you carry on, it's likely you're going to see some movement. doesn't mean it's going to happen. What could happen is we could just see things like the CAD yen do that for a few weeks and then gradually start to move down ever so slowly over a period of a month or so. What they're saying is we're watching, and if you keep on squeezing and devaluing our currency, we will do something about it. It doesn't mean it's going to happen. We've had many times where the Japanese have come out and said exactly what they're saying now. We are closely monitoring the markets, and if you don't stop squeezing us, we're going to do something about it. And what happens is they do this. Over a period of 3 or 4 weeks, we get a nice downside movement, and then it all goes quiet. And then it all starts to rally again. And then you get the whispers coming in again and saying, at this point, they would have been saying, we're closely monitoring the FX markets. And then you get a move like that, which is 500 ADR. That's them going, stop it. Then you get the proper intervention, which is 500 to 800 ADR plus, and then you just get the yen powering up like a crazy thing for months. This can happen without them intervening because the market will still need to take profit on this move that it's done. It's massively squeezed the yen, a little bit of a profit take, massively squeezed, yeah. So it could just reverse on its own as normal currency movement. It doesn't have to be an intervention, yeah. So I'm not saying the yen is 100% going to move 3 to 500 ADR. No idea. I haven't got a clue. I don't work for the Bank of Japan. I have no idea. But all I'm doing is saying in the past, when we see this being said on an almost daily basis, that is the precursor to a massive intervention. Or everyone goes, yeah, you're right, sorry, and they back off. And if they back off, we just get normal market movement, normal profit takes, normal everyday what we see, up, down, through time. So I don't know it's going to happen. All I'm saying is, if you're long XXX JPY, when they intervene, you're in massive pain. Massive. That's all I'm saying. Yeah. You want to be in the yen at the moment. It's safer because there is a chance that they will intervene of being short than long. If you're long and they move 500 ADR against you and then rally for 3 months in that direction, which I've just shown you happened last time, you don't want to be long in it, do you? That's all I'm saying. I'm not saying it's going to go anywhere. I never know. Nobody. I'm saying here all the time, don't I? I have no clue where the market's going, up or down at all. I haven't got a clue. No one has, because if we knew that, we'd been billionaires. But you can see, obviously, that there is a little bit more strength coming through on the yen at the moment. So it doesn't mean we're going to get we're going to be down at the 24 later this afternoon. It means that it's on its way. So all of these yens that are extended to the upside. So CAD yen, big extension to the upside. We've been extended to the upside for weeks. Yeah. It's carried on going up. Yeah. My first entry was here. Yeah. It's going up. But when it comes down, you know, you can see how easy it's going to be to make money on this. If we just get a normal 2-day push, yeah, out with a load of profit. It's not an issue. But if we get an intervention, you want to make sure that you've got some TPs. Like you can see, I've got one down here. Yeah. That is going to pay me massively. So if there's an intervention, that's hitting the jackpot in Las Vegas. That's just a normal trade. Yeah, have those little jackpots on, because when you get those 5 ADR moves, why not take the money? Yeah, it's all about making money at the end of the day, this job. And if there's an opportunity you can foresee possibly coming in the future with a percentage chance, go for it, take it. So CAD yen extended to the upside. We are holding that high. So for the last four-hour candles, we are rejecting the highs. We've got this last push here. Remember I said with all these squeezes, when a squeeze comes to an end, what you tend to find is it ends with a big daily push. In this case, it's not really that big of a daily push, but we had a nice big try to get down and then we pushed all the way back up strong. So there was actually quite a long, strong push on Friday because they were all the way down here on Friday morning and they ended up all the way up there on Friday afternoon. So there's a lot of buyers stepping in off of that 2-day rally. Yeah. So, you know, two down days, that's all you want. You get 2 down days in and you're out, you're done. Just waiting for that to kick in. So CAD yen is in the same spot as the Swiss yen. Swiss yen is also very extended. 4 hour hourly was extended back there, but the 4 hour obviously extension, we just come out of it now. We're just about to come below the 70 level. Again, same thing. Just looking for a little bit of a pullback on it, but if it does that big one, then we'll take the big one. Again, you know, your top trade, basically, you can see I've got one trade up here. Make that your runner. So you stick that down there. So that's going to be 3% if that drops down to there. I've no idea where it's going to go, but that's 225 ADR. If there's an intervention, we know we get 3 to 500 ADR. Yeah, so that's 400 ADR. So let's say, for example, it does that today, and then they intervene tomorrow morning and put in a 500 ADR. Why not take 3%? Yeah, make some money on it. If and when. If it doesn't happen, it doesn't happen. End of the day, if we just get normal market movement and we're down there on Thursday, take it all off, same as you would any other trade. So that's the Swiss yen. US dollar yen, I'll quickly cover that one as well because that's extended. That's coming down like a rate of knots. So this looks like US dollar weakness. We've got a little bit of a US dollar weakness at the moment, and obviously we've got some yen strength starting to show. So that's coming down very, very nicely. Was extended on the 4 hour. It's obviously coming out of extension now. The other two we've got are Australian dollar mixed with euro and pound. So this is pretty much the same trade. If you look at these two, market movement is very similar on them. So euro odd, big extension to the upside on the 4 hour. So we're up at above the 75 level now, same as we were there. And obviously inverse of that. So looking for a continuation to the downside. Again, euro really struggling to push at the moment. We should be seeing euro strength. We've got Lagarde coming out and talking tomorrow. This afternoon, this evening, 6:30. And obviously again on Wednesday. There's very light euro news. We've got the CPI figures for Germany coming out on Thursday. The German CPI figures don't come out at a specific time because they're an amalgamation of multiple states and they all release their CPI figures at different points. So there's never it comes out at this time because it depends when they've got all the data together. But the German CPI is kind of seen as the European CPI because it's the biggest economy. Therefore, the biggest movement in inflation in the biggest economy tends to have the same sort of effect across the rest of Europe. So this is in effect the European CPI figure. That's all we've got really Euro news this week. And there's talk of a 0.5% increase on interest rates for the euro, and that's what the market is factoring in as its next sort of move. The euro is sitting behind everybody on 4, so it's the weakest interest at the moment. Therefore, there's not as much benefit to stick your money in the euro. Even when we've had interest rate rises, it's had a negative reaction. So very much the same as the US dollar at the moment. Market's not reacting massively positively to any interest rate rises. Think about it, if they just jump up by 0.5, yeah, in the same way as we've have just in the UK, they're still behind everybody, aren't they? So, and their inflation figures are still fairly high. The problem with the Eurozone is the unemployment, which is why this is low. As you increase that, you increase unemployment, which again, in turn, has negative impacts on everything else. So they're trying really hard to keep a cap on that, but there's only so much you can do before you have to go, we have to pay the price, and the price is unemployment. So we'll see what happens with that euro, but I think maybe potentially weak. DAX is at last week's low, is it? Yeah. Okay, so there's a lovely ORB today on the 5 minute. So the 5 minute ORB worked beautifully today. Absolutely fell out of bed, didn't it? Lovely. I wasn't on that today, but yeah, nice. So there's last week's low, tapped into, limit orders have triggered. So watch this for a bounce up for those gap fills. So beautiful ORB today. Again, this is the thing with the opening range breakout EA and the opening range breakout strategy. You have no clue which days are going to be the paydays and which days aren't. It's going through the lows. Look, we're at ADR. So ADR in half an hour today. So look out below. Maybe this is a reaction to the trouble in Russia at the moment. We might be finding, again, yeah, perfect sense, isn't it? I should imagine all sectors are selling off. Yeah. So this is a sector sell-off across the board. So you can see all indices coming down at the same time, which means they're selling stocks. Yeah. So when you sell stocks, you have to take that money and you have to put it somewhere else. Typical location tends to be safe haven currencies, which tends to be the Swiss franc and the yen. What we're seeing this morning on the yen strength. So they're pulling money out of the stock market, they're putting it into the Japanese yen, which will obviously please the Japanese because they've just told us if you don't stop doing what you're doing, we're going to intervene anyway. So this is either a sector sell-off because of what's happened in Europe with Russia, or it's basically a case of, yeah, guys, we need to buy some yen. Pull the money out of the stock market, buy the yen, just in case, because they'll make a hell of a lot more money if you've got a load of yen longs than you will playing in the stock market at the moment. So, yeah, so that's obviously selling off hard. So try not to get in the way of that today. If you took a buy on the limit order bounces there, obviously you stopped out on that one. Next stop, look at this while it's going. Next stop on the DAX is monthly low, which is there. 150 ADR is your monthly low. And obviously you've got this area here. So this area here that we're coming up to, which is pretty much where we are at the moment. This zone where we've got all these wicks here. So obviously that is a very, very, very strong support. So somewhere around there, potentially, you might find some buyers. If that fails, we're looking at last month's low. If that fails, there's something wrong. So just go with momentum. Momentum today is down. But obviously FOMO, you're a little late. You missed it, which is why you take the opening range break. Because if you're going to get on these days, you've got to get on them when the market moves, not after the market's moved. But if you want to take a short on it, obviously you can wait for a pullback. Look at a 38 to 50% pullback and short it, but you may have well missed the move today. But certainly something has spooked the market this morning, isn't it? More likely going to be the banks. Bundesbank may need recapitalization to cover bond buying losses. So another bank in trouble. A lot going on this morning. So this could be off the back of that Bundesbank news as well. That came in at 8.19. So yeah, now that's just come in. But I mean, that just because we've just heard it on the wires doesn't mean the banks didn't know about it beforehand, obviously. So selling that off. Tricky one. Okay, so pound odd extended to the upside at the moment. So that's a 4-hour RSI extension to the upside, and euro odd, obviously, we just looked at. Nicely extended to the upside. Again, euro potentially not going to be particularly strong. Australian dollar also shouldn't be particularly strong either, though. So if this is going to come down, you kind of need a power move in the Australian dollar. Or you need some weakness in the euro. But Lagarde's going to come out this week and she's not going to talk the euro down. So, and pound odd, obviously, the pound, if you look at all the pound pairs, after the news last week, so we had CPI staying where it was, which is bad for the currency, means we need more interest rate rises. The Bank of England responded by putting the interest rate rises up by 0.5% instead of 0.25%. What's the market done? Absolutely nothing. Not paying any attention at all. So I would have expected a big bullish move off of the pound last week. We didn't get it. So if we're going to get delayed reaction, this might be the week that we see that pound rally. So watch for levels up at highs. But wherever it goes, if it's going to rally hard, it's going to leave propulsion targets, and those will get filled at some point. So got one short on it from Friday at the moment on the pound odd. So yeah, good looking opportunity for a short, nicely extended on the RSI. So, and a really nice level up at 125 ADR for a double top. Big move, no profit take. So again, big squeeze, multiple days, completely undone, V-shaped recovery. Seeing a lot of this at the moment, these V-shaped recoveries and A-shaped recoveries. Market's really just not got any directional bias. Just doesn't know what to do, does it, at the moment? Which is not surprising because nobody knows what's happening. Housing market's about to go pop. Interest rates are going up. People can't afford mortgages. War in Ukraine seems to be escalating. Potentially, energy prices are going to increase again. Food prices are not stopping. The biggest grain producer in the world, Ukraine, is not producing anymore. The Russians have taken control of grain depots and are selling it on the black market for twice the cost. It's all going wrong. So as for predicting future FX movements, good luck. Just get in and get out. Don't worry about which direction it's going. Get in, wait for the movement, get out. That's all you can do. Which is great because it suits our strategy perfectly. Because we've realized that you can't forecast price movements in the future. Been testing, taking profits. Yeah, good morning. Outro, it's official. I love the DAX again. Yeah, so that's a lovely ORB today. But, you know, for every time you have a rule that, and it's the same as any trading, no matter what analysis you do, no matter what testing I do with the opening range breakout, you come to the conclusion that it really doesn't matter. You can minimize losses by removing certain trading conditions that you have identified visually that break a lot of the time. For every one that you go, brilliant, I didn't get whipsawed today, there'll be one that you go, wish I'd have taken that today. Yeah, you have absolutely no way of knowing what's going to happen at the open. No one does. So you can eliminate the most obvious whipsaw opportunities where you've got really, really tight little ranges and like a tiny movement up and down. That's it. You're stuffed. Yeah, get rid of those. But the days where you get those tiny ones and it goes boom, like today, you're going to go, can't win. You can't win. Sometimes it will work, sometimes it won't. Big rejection off of ADR and a bull candle going in. So potentially starting a pullback. So if you want to look at potential second entries on this, shallow, medium, deep pullback. So that previous support will become 61.8 resistance. Yeah. There's your 50 in that propulsion gap there. So let's look at the hourlies. Yeah, so you got a propulsion gap going in obviously here. So that low, when this candle closes, wherever we close, that's where your propulsion gap is going to be, obviously after the next candle. So difficult one to get into, but they're certainly rejecting that previous low, aren't they? So that was a quick rally down. Liquidity gone down there on anybody that decided to long it. Not that I think there would be many people longing it on Friday, but anyway. Yeah, all those targets to the upside. So from an entry perspective, yeah, if you want to get in, if you're going to play now a gap fill long on the DAX, yeah, so we've got gap there, we've identified, we've got gap there, we've identified, we've got big gap there, which is kind of filled really big gap from yesterday, yeah. So if you're going to take a gap fill long, I feel like I've got a creature on me. Right now, if you wait for a 5-minute reversal alert, there and enter there, so that's a confirmed break structure back to the upside. Stop under that low, hold it for this week until we get some of these gaps done. There's a massive risk reward opportunity for you. So take that entry there and it works. Obviously that's the big if, isn't it? So that gap fill there is 2.5R. That gap fill there is a 3R. That gap fill there, which is probably the biggest target, is about 5.5R, and then the final gap fill at the high there is 7R. So if you took 2 entries on the next reversal alert, yeah, target 1 at the gap fill, move the second to break even, off you go, and just see where you get to. This took a week. Why not get back up there in a week? Yeah, we don't know which way the market's going, obviously. As whether we're back in this bull market. We discussed this on Friday in a bit of depth, whether we're back in a bull calm regime or not. DAX, when you look at it on a 4-hour chart, you're looking at thinking, yeah, that looks pretty good. Then you switch over to the S&P and it looks pretty good. And then you look at something like the Dow and it's like, maybe not. So it's very difficult to tell whether we are entering back into that bull market. Market did not manage to hold that high. Yeah, we came straight off of it again last week on the Dow. So we are potentially hovering at the high of the next leg down. The S&P, people have been calling the COVID high since this rally began, and we haven't hit it. How was that? Yeah, so that was the target. As soon as we got that bear run started and everyone was like, uh-oh, that is where the market was calling. We didn't get there. Yeah. Think about what happens in a bear, in a normal market structure. Yeah, 50% retracement is a medium pullback. Yeah, so on that move that we're seeing there, that's a 61.8, 71.9 basically. Deep pullback, continuation short potentially. Don't know. Tricky, isn't it? World is still in absolute turmoil at the moment, and nobody's really got a clue which way anything is going. So we'll see what happens today. But I still think there's more downside on this, on all these markets. So there's your monthly low, obviously, target on the DAX. So if you get in there and that doesn't work, you want a second bite of the cherry. If we get 175 ADR today, or 150 to 175 ADR today on the DAX, which is that monthly low, there's your range established. Back up. So good looking long opportunities, but don't get caught in the trap of just continuously trying to long this. Yeah. Don't, if it breaks that level and then it hits that and then breaks that level, don't keep longing it because you're going, or at some point it's going to go. It doesn't have to. It's a stock index. If they want to start selling stocks, they'll sell stocks, and stocks will get sold until they don't get sold anymore. You won't just, these aren't moving like normal markets at the moment. So don't go crazy. Right. That's all those. So nice bounce there off of ADR. So just watch this low for potential resistance. Morning, Astro. Morning, Tony. Yen intervention coming by the looks of things. More speaking on financial juice. Yep. So we covered that this morning. So this is 3 times now today. So we've just had Matsuno at 8:10. And then earlier this morning, we had Suzuka at 3:45, saying the same thing. And then before that, we had he didn't say anything, did he? No. Then we had Kanda just before midnight. So that's 3 times this morning. 3 different representatives of the Bank of Japan have shot across the bow saying, do not keep selling the yen. Not up to us, it's up to whether the banks listen or not, but I am certainly not longing anything against the yen at the moment. In fact, if you've got the market reverse alert CA and you're using that to scale into positions, it's worth getting rid of all targeting. So don't have basket targets set up. Don't use TPs. Just sit there in positions if you're in positions short against the yen. And if that intervention comes, just go and make a cup of tea and come back in an hour. Because what the temptation is you see a candle, if this is obviously if it happens, and I'm saying it now and as if it's going to happen today, it could happen anytime in the next month. Yeah, it's not just going to, you've no clue when it's going to happen. It's just may happen. If it happens and we're sitting down at 175 ADR, it's so tempting to take it off and go, whoa, what a trade. But go and look at what happens in these situations when we do get interventions. Yeah. 170 ADR is just the tip of the iceberg. 121 ADR. That intervention was 578 pips on 120 ADR. Yeah. This intervention here was tiny. It was only 560 pips on 120 ADR. That's 5 ADR in 4 hours. So don't get out at 200 ADR if it is an intervention. And you'll know it's an intervention because you'll see it. It'll be obvious. Oh, I knew it was going to do that. Where are we? 21st of October. Why are we back at January? There we are. Yeah. Whoa. Yeah. So bear in mind let's draw it on. So 120 is an ADR, yeah? Look how small an ADR looks in right? So we didn't go anywhere. So this is the candle that started to move. That's an ADR. Yeah. So that one candle there, that one candle was 2 ADR. And where the move started, the lower that candle, 2 ADR. Then the next candle after that, yeah, that's 3 ADR, that one candle. So when you see one candle go in with no news events, that's 100 to 200 ADR, go and make a cup of tea, go and chat to the wife, go out for lunch, take the dog for a walk, do something. Don't watch the charts because you'll just be going, I've got to shut it. I've got to shut it. There's so much money on the table. Trust me. Come back an hour later, you'll have twice as much money on the table. Yeah. And if you then go, oh no, it's pulled all the way back, shut your charts for 2 days, go off and have a break and then come back because after that, you're going to see nothing but this. Because as soon as that has happened, the market cannot sustain any more long positions against the yen. It just won't do it. So you will be quids in. You've just got to have iron balls and hold it. That's the trouble. Trying to hold it. Yeah. You look at the previous intervention before that. Well, that one there. Yeah. So that one candle there, the intervention candle, was 520 pips off of 120. So that's an intervention. This is a news event. Look out for stuff like this beforehand as well. You get these like, do you remember, I don't know if anybody was in here when this happened in September. I said in the live room, what the hell was that? Be careful. This looks like they're about to dump a massive amount of orders into the market. And that was your warning shot. Like, this is a normal 1 hour candle, in the yen. Yeah. Yeah. That's a big candle. Typically you would think, right, that's a news event. That there was 180 pips. That's 200 ADR in one candle whipsaw. There was no news. That tells you something's coming. Something's not right, is it? That's not normal, is it? You get that sort of movement in there, clearing the decks. Every single order, long or short, gone. They're all dead. The spreads on this thing as well would have been hideous. And then you get the move. But, when you see that, the market doesn't go, oh, let's buy the crap out of it. They go, get out of those positions and short it. So you always get an after shock, if you like. And yeah, pull back for a few days after that. But this was the initial intervention. This was your shot across the bow. The market didn't pay any attention. Then they really kicked him in the butt, and that was it. Back. Final blow. Double tap. Off you go. Yeah. So just, like I said, it isn't guaranteed it's going to happen, obviously. But and exactly the same thing. We were having all this stuff on financial juice for days and weeks before that big whipsaw went in. That is exactly what they did last time. And they've done it many times before. I can remember probably 5, maybe even 10 interventions from the Japanese over the years. They're one of the only countries that does it. Swiss do it every now and again as well. But and the Swiss warned us as well. Jordan warned last week. We will take measures if we see weakening in the Swiss franc. You know, that was don't muck about with the Swiss. People don't muck about with the Swiss. They don't do it. But the yen, we do, because they've got negative interest rates. So that's why they don't buy the yen. This is why the yen is so weak. If you're getting a negative 0.1 interest rate when you put money into the yen, why would you do it? So you don't. So we're always selling the yen. No one wants to buy the yen, which just makes the Japanese economy collapse. So they have to do these things to keep themselves afloat. They don't have a choice. Or they have to hope that the market is kind and go, all right, for a bit, we'll support you. If they don't, they will support themselves. Survival of the fittest. Same in FX markets. Morning, Neo. DAX at last week's low. Yep, covered that. I'm in 2,000 so far. 2,000? 2,000 what? Amy. Okay, there's your retracement complete back to previous support. So watch price action here. Yeah, but don't forget, you have to make your mind up. Are you long or short? Are you a gap fill trader and thinking, well, not always a gap fill trader, but are you thinking now, I like the idea of gap fills, therefore you do not want to be taking a short there. But if you are, hey, look at this thing, Lee, this thing's coming down like a house of cards, I want to be short on it, that's where you want to get short. I don't know where it's going, but those are the two plays, aren't they? We're either gap fill long or continuing like that today. Pick a side. Any tips or tricks to get around lack of confidence in your trading? I'm a scalper. Stop scalping, Tony. Okay. And had the low marked on the DAX, expected limit orders, but didn't press the button. You just got to press the button. The problem, and again, you've watched the boot camp. What you're describing is one of the problems we all have. This is why position trading works, because you've just described exactly what everybody in here experiences all the time. And you can never have confidence in your trading if you are constantly stopped out on your positions, because you will never be able to get faith in your strategy when your strategy fails all the time. Yeah. So when you look at this slide here, it explains everything. Yeah. DAX has gone short today to ADR. It's pulled back. I'm going short. Fear of missing out. System hopping. What you've just said. I've not got any confidence in this system. It doesn't work. I'm going to go and try another one. That is the cycle that everybody needs to break, because that's the cycle that you will be in for the rest of your life, because you won't find one. You just won't find one. It doesn't exist. Trying to pick the tops and bottoms of ranges. Trying to pick the pullback point on a trend. Everything I've just said about this morning, this is all, whenever you're using a stop, you can't not have these. So you will never be 100% confident, because you will experience 50% of the time all of this in every single trade you take. Half of your trades, you will try and do that and fail. So how can you ever have confidence in something that only works half the time? The half that it does work, unless you're getting a 1.5R on every single trade or more, your strategy is never going to give you confidence. Yeah. Not being able to hold on to winning trades. Like I said with the DAX, we've got 5 targets to the upside there for gaps. Oil, my oil trade, I held on to it for a week to get 4R. 4R a week. That's normal. It's not easy to do. Every time that thing pulled back on oil, I was like, here we go. Because I've seen it for 15 years. I've seen it stop me out for 15 years. There's only so much stop outs you can take before your confidence is knocked and you just give up. Getting in just as the market turns the other way. What you just said. You could have taken that long off of that last week's low. Yeah. And then immediately it does that. Nothing you can do about it. If that's what the market wants to do, that's what the market will do. Just because it bounced off of last week's low doesn't mean that it's now going to go long. This candle, this next candle, if there's more sellers than buyers, that candle is going down. There's nothing you can do about it, and there's no way that anyone can predict how many buyers or sellers will be in the next candle, because the next candle is down to which time frame you're looking at for a start. It's always going to be different for everybody, isn't it? You can't predict it. Revenge trading, again, taking 50, you know, if you take 50% of your trades being losers, you're going to get cross. You're going to revenge trade. All this stuff. You know, I can't offer any tips because there are no tips. Psychologically, you're a human being. You're programmed to protect yourself. Protecting yourself means you need to earn money. To earn money in this industry, you need to be right. You need a system that is right. If you've got a system that is wrong 50% of the times, that's not right. You can't stop yourself being human. If you take out of the equation, the one thing that stops that human emotion of loss, the stop loss, you stop all of it. It stops. So you take that double bottom on the DAX, you know, so today, if you were looking at that trade, if I was looking at that trade today, I wouldn't do this on the DAX because I don't position trade the DAX. But if I was taking that trade today, I would go long because I saw that and I'm thinking that's a limit order trigger off of the last week's low bounce. I'll take a long there. If it doesn't work out, what I'll do is I'll take another one down here at last month's low, which is 150 ADR. So if it doesn't work out, I'll do it again. Because if that one didn't work out, that one probably will. Why? Because my strike rate on support resistance bounces has got 50% success rate. So fail, fail. Oh, if that doesn't work, I'll find the next support. And then I only need a 33% chance of the third one bouncing. And if that bounces, these guys will be so squeezed into it, they'll definitely want to take profit on their move. But if you start thinking that way, I haven't got a clue, but I know I've seen it before. I haven't got a clue, but I know I've seen it before. One of them will work. Timing. Can't do it. How can you time something that is completely random, driven by 10 banks who don't know what each other's doing? There are no tips or tricks to get around anything in this job. It just doesn't exist. But that's what everyone's trying to do, isn't it? And that's why everybody fails. So, but if you are, the only thing I would say is if you're having a lack of confidence, it's probably caused not so much by your faith in the system, strategy, the trade itself. It's probably caused by the fact that there's too much money on the table when you press the button. So if you're worried about pressing it because you're worried about losing 1% of your account, drop it down to 0.25%. Are you still worried? If not, that's where you need to be trading, 0.25% risk. Because most people's fear of getting into a trade is the fear of the loss. Not the fear of being right or wrong. It's the fear of losing too much money on the trade. If that's the problem, you've got too much risk, which is why position trading works. Because it doesn't, every time you press the button, it's such an insignificant amount of money that if it doesn't work out, it doesn't matter, I'll deal with it later. And you're buying yourself time as well. If you're risking 0.25% on a half an ADR's movement, I mean, admittedly, this did ADR in half an hour today, but normally you wouldn't hit ADR for a day or two. So you've always got so much time. Scalpers, you haven't got any time. If you're scalping on the M5 time frame, by the time you've had a think about this, you've missed. Like if you saw that candle here, yeah, and you're like, that is a beautiful bounce off of last week's low. I might take that. Let me go out and have them do some analysis and look at where targets might be to the upside. By the time you've come back, it's putting a bullish engulfing and you're like, yeah, definitely want to take that. You just missed 28 points. Almost a third of an ADR in movement you missed on 5-minute candle. You ain't got time to react, which is why scalping is so difficult. Right? Everybody, I've just pointed this out twice now. Has anybody taken it? You should have taken it there, not here. Because you just missed all of that profit. Now, you've got to get down to there to get a 1R return. If you'd have entered there, that is a 2R profit. You haven't got time to think. Scalping is just so hard, which is why you need a mechanical system like the opening range breakout strategy. Don't think about it. Let the market go. If it goes, it goes. Fantastic. If it doesn't go, you're going to lose money. There's nothing you can do about it. The less you think about it, like with the ORB strategy, there's set rules. You take the pre-market 5, you take the pre-market 15, or you take the initial opening range break. That's it. Take it. Let the EA take it for you. You don't even get involved. Let the EA take the trade. Right? EA's got me in short. I haven't got myself in short. The EA's got me in short because there's a proven long-term edge in the opening range break. Is it going to work today? I don't know. Don't care. It did obviously work massively well. But will that work? I don't know. Just take the trade. But if you're worried about taking it, because if that costs you $1,000, yeah, and you're trading prop and you've got a $5,000 loss, and that is worrying you, that's too much risk. If you were risking $250 on that, you wouldn't be worried about it. Or let's say, for example, you take that trade from there or from on that shooting star, yeah, and that would be your risk at $250. Why not make it that big and risk twice as much, but give the room, give the distance, give it twice as much room to move? And then if it gets down to there again, take the trade off. Yes, it's a negative R trade, but it's profitable because you gave it room to move. Just giving you options. There's no rights or wrongs. But confidence, in my experience, is just a lack of faith in the strategy. And usually a lack of faith is caused by too much loss experienced. Too much loss experience is high risk. Where everybody's taught to risk 1%. I mean, some of these courses teach you to risk 2%. There's a compounding course out that teaches you 5% risk per trade. 5 trades in a row, you've lost 25% of your account. Nuts. How many times have you had 5 trades go wrong in a row? Aussie New Zealand. Look at my Aussie New Zealand. I don't know how many trades I had wrong in a row. I'm not losing 25% of my account just because something squeezed for 2 weeks. That's ridiculous. It's not even 25% of my account, is it? That'd be 25%. That might be 16%. That'd be 12%. Probably blown the account by there, haven't they? Well, you've blown the account. Look. Silly. Amy, $2,000 plus on your evaluation account out of the opening range breakout. Good job. Nice one. And those are the days, we've had these. This is the thing with the ORB strategy, constantly getting messaged by people. How can I stop getting whipsawed at the opening range? You can't. How can I stop getting run over by a car that's moving at 70 miles an hour? Don't stand in the road. If you want to play risk, you have to put risk on. Sometimes the risk is not going to work out in your favor. That's it. That's trading. That short there is either going to work or it's not going to work. If you don't put the risk on, you won't find out. If this has got 200 ADR to the downside today because there's a catastrophic sell-off in the stock market and they're piling it into the yen because of the yen interventions coming and they're worried about Ukraine, this thing's doing 200 ADR. If you don't press the button now with a stop up there, you will never find out if that's going to be the right trade to take today or not. Just got to get in. And if that is worrying you because it's going to lose you 1/5 of your potential daily loss, there's too much risk. However, what I would say is, if you're going to take 5 trades like that today, you're over trading because it's going to take half an hour or so for that to stop you out. So don't forget the DAX, you kind of stop trading at 2 o'clock. You find it hard to get 5 trades on if you're risking 1% anyway. Wayne, when you say 4R on oil, did you use a propulsion gap and the level to determine the exit? No, so that 4R on oil was highs, basically. So target was here. So the trade was, it needs to be on the hourly. So the trade was off of this candle here. Yeah, that was the risk. Oh my God. So that was the risk. So that's 4R. Yeah. So when I got in there, just scroll out and show you what I mean. So basically, it was making lower highs. Yeah. So that was the high, the last high. When I got into that trade there, that was the last high that I had seen. So they're one of these black lines. Yeah. There was a line there, which was high of the week, the previous week. So that's my target. If we're going to stay in a range, I would expect it to react at last week's high. Yeah. What I'm expecting is a new range low to be formed. So if I'm going to stay in a range and I'm trading from a range low to a range high, I got two options. I've either got a mean reversion trade into the center of the range or the high. So the fact that we're making lower highs means that really is a push, isn't it? Because if we're going to carry on making lower highs, what are we going to do? Exactly what we did, put in a lower high. Yeah. So that was my target. That propulsion gap there, that propulsion gap there, and that propulsion gap there were all in play when I got into the trade. So your targets are ultimate target. There's a propulsion gap there, which got filled. So bear in mind, we're here. This is where we're entering. Yeah, so none of this exists. We haven't seen that. The time of taking the trade here, I could see a propulsion gap there, a propulsion gap there, a propulsion gap there, a propulsion gap there, and that double top, which was last week's high. That's why I targeted last week's high. Yeah, so that is 6R, that is 5R, that is 4R. So my target was 5.5R. Basically, that's where my TPs were sitting there. But you could have got out with a 3R there. You could have got out with a 2R there. So literally, I got in there. The next day, you had a 2R exit. Following day, you had a 3R exit. You never got to my target because it just didn't get there. And that is where I said on that day, yeah, this day here, this is the live room here. And I said, we've just pushed up again, but it looks like we're going to potentially reject these highs because we made a big new low and there was a potential for this to do an outside bar down, which was possible and it's what happened, but I didn't know obviously at the time. So what I did was I moved my stop underneath these lows as we started to rally. By the New York session, I was out. Luckily, because that day was like multi-ADR, like 370 on a 25. So it's 150 ADR straight down. And it would have stopped me out at break even. But I didn't know that at the time, obviously. So you just, this is a really good example. There's no, people try and teach you mechanical ways to trade. And you can build EAs to do all sorts of modeling. And I've built thousands of EAs over the years, not thousands, hundreds, modeling specific things. And you realize that it doesn't matter how much you model, when you actually are in something, there's no exchange for experience and seeing stuff happening. And your brain will get chart patterns burnt onto your retinas that you won't even know are there. You will see things unfolding and you'll go, this looks like it might do that. You don't know why, but you just feel it. And it's you hear other traders, you must have heard other traders in the past saying, I've just got a feeling this isn't going to go this way. I've got a feeling this is going to happen. The feeling is there because they've seen it unfold in every single permutation of what could possibly happen so many times. You're subconsciously going, right, we're pulling back here. If this doesn't pull back, right, my reward is there. I'm so close to my reward that if this collapsed, I'm just going to lose it all. So I'm not going to lose it all. I'm going to take that 4R because 4R is a bloody good return. But the chances of me getting a 5.5R when I'm sitting at 5R, I'm risking all of my profit for a potential half an hour movement to the upside to get the glory of hitting my TP or lose the lot. Lock in. But you've no idea what's going to happen. But when you see a move that fast and that hard off of a triple top, it just rings alarm bells to you and just go, well, that doesn't look very bullish to me. And the fact that we're making lower highs just kind of adds up to the fact that it looks like it's bearish and it's been coming down for the last year. Everything just makes it up, but you can't model that. So you pick somewhere and you hope it gets there. And if it gets there with a 2 ADR move, this is what I said. When I took this trade, I said this was a Friday, that was the Monday, and I said, nice, doing really well. The Tuesday in the live room, I said, right, I'm moving my stop to break even because this has moved so far, it's halfway to our target in 2 days, right? I don't care. I'm either going to get stopped out in break even and this is going to go, or it's not. And it came all the way back, nearly stopped us out, and then made a new high the same day. Yeah. So from when we moved stops to break even here, it pulled all the way back, and then it made a new high in 24 hours over an ADR of movement. I have no idea when I moved the stop to break even on this day, whether that was going to happen or not. But if you try and model it, so people will try and build EAs that test, right? Okay, so when it's moved X again, we'll move to break even. Which is the best way to do it? Should we move to break even after 3/4 of an ADR, half an ADR, 1 ADR, 2 ADR? And should we do it at the open of the day? Should we do it as it's a trailer? Should we do it on candle close? Doesn't matter. They'll all kind of work sometimes, and they'll all fail sometimes. But if you won't find one that works all the time. You have to do this manually. This is a job that you have to be involved in, which is why the Market Reversal Alerts EA, I kind of market it as a semi-automated EA. It's there to help you enter positions without you having to sit there and watch the charts. There's 1,000 million combinations of settings in it, and they will all produce completely different results, but none of them will ever reproduce the same result again ever in the future, because this market will never reproduce the same thing ever in the future. The movement that we saw there on that day hasn't happened before, and it won't happen again. There'll be similar days, but that won't happen again. So how could you possibly model for that happening in the future? You can't. You have to just get in and worry about it when you're in it. See what happens, because the market doesn't know which way it's going. So you just have to say, right, every time we get these double bottom bounces, a lot of the time they bounce. When they bounce, they quite often try and bounce back up to the top again. Look at what happens on a daily basis and make up your mind. It is that loose. There's guys that advertise on YouTube. You probably see them when you're waiting for the live room. They come up and say, everybody that has taken an FTMO challenge with my mechanical trading system has passed. Every single one of them, because they took the evaluation on the same day, and it just so happened the mechanical trading system had a 5-day rally. Everybody that took my FTMO challenge the week later all failed. Every single one of them failed. Do you think that's a good advert? Why doesn't he show that week? Because the rules are different that week. The market was different that week. Everything's different that week. You're not going to get the same thing happen every week. So yeah, if you'd have bought his mechanical trading system or strategy the week that everybody else did on the FTMO challenge, first of all, FTMO would have flagged it because everybody took the same trades and hit a lot of them out. But secondly, that was the lucky week. Same with the ORB EA. You set the ORB EA up on your chart, and some weeks it's going to have a mental winning streak where you'll make 25 grand. Other weeks it's just going to sit there and stagnate for 3 weeks and make absolutely no money, because the system and strategy doesn't know which way the market's going. So it is that simple, which is why I built the position trading bootcamp, to explain how the market works. We don't know where it's going, and if you try and predict it, you are literally flipping a coin. Yes, certain things repeat themselves. I took that trade because I've seen support and resistance. This is why these black lines and these purple lines are on my chart, because I've seen this happen 1,000 times over 15 years. I draw them on there because there's a high probability of that happening. Not because there's any magic or science. It's because that the market places orders at yesterday's highs, yesterday's lows, last week's highs and last week's lows to trigger when it gets there. They're automated orders triggering. That's why it works. There's no voodoo. It's just the fact that the banks have dumped 25 million to trigger there. So it did, because it was told to. Whether or not that 25 million they triggered is more than the 50 million the other banks have got to drive it the other way, I don't know. But what I do know is that that happens. And then once that's happened, there's a 50-50 chance that the banks that started that move will be able to continue it. I don't know, because I don't work in the banks. But that's what happens. So the odds are always the same. It goes up or it goes down through time. If you try and predict that, you're just wasting your time, because you can't. So, yeah, there you go. Hopefully that helps. Obviously, it doesn't help you if you're trying to build a system or strategy, because it's just blowing out the water. But anyway. But that's why I took the gold trade. And that's why I took the target there, because that's what I would expect the market to go for. It didn't get to the monthly there, you know, and it didn't get to the weekly there. Now we've got a new weekly high there and a new weekly low here. So that is our current range that we're sitting in from last week. So all we're doing, if you think about it, is we're looking at what happens on a week-to-week basis. And we're deciding, are we going to be in what's called a control candle or not? And a control candle is basically a candle where price doesn't manage to break out of. So this here is a control candle. Yeah, this one there. So we had this big down move, and then the following week we got an inside bar, followed by 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 an inside bar, and I keep going and going and going until we broke out of it, and then we came back in. Yeah, this is a high and low of a range, which was a high and low of a weekly range. That high and low of the weekly range then changed. All we're doing is we're waiting to see if the market is going to respect them, and that's what it does 90% of the time. Respects support and resistance over and over again, because when the market pushed down from there, it's because there was a lot of selling orders coming in from the banks. When the market gets back there, the banks put those selling orders back to drive it away again, because they're short. So there you get double tops and double bottoms, not through anything more than pressure of orders sitting in the market placed by institutions with enough money to draw a candlestick. That's all that's happening under the hood. Which is why you've seen the market do what it does. It rejects down here because the sellers tried to sell oil down there. And everybody that was buying oil said, no, we don't want to sell it down there. We want it to be higher. So there was more of them buying it than there were selling it. Therefore, it moved up. What you're trying to do, if you think about it when you're trading, is you're trying to predict whether or not the banks have got more orders long or short. How could you ever possibly know that? Unless you have got a spy in Barclays, you don't. So, which brings me back to what we were talking about earlier with Tony. Any tricks or tips to get around confidence? Forget confidence. You can't have confidence in a 50-50 random flip event. So remove it. Remove the stop, and you remove the need for confidence. Because I'm not confident. Every time I take a trade, I'm totally not confident. I've got a euro US dollar long on at the moment. Am I confident that's going to go up? No. Do I care? No. Because if this thing moves down to there, worst case scenario, I'll be sitting in something like $400 a drawdown, 0.4% of my account. If it moves 150 ADR down today, that's the worst thing that can happen to me. I have no confidence in the euro or the US dollar at all, because the market hasn't got a clue what's going on, because interest rates and inflation in the world is collapsing. Doesn't bother me. As long as the market moves up and down because the banks take profit on moves that they make, that's all I'm interested in. What I'm not interested in is the banks constantly pushing something for 4 to 6 weeks in one direction because something's happened in the world, or they've decided we're going to screw everybody that's decided to buy this or sell this. That I can't control either. So again, do I worry about it? No, because I can't control it. If you try and control something that's uncontrollable, you'll never get anywhere, will you? Just got to stop. I don't know where all that came from this morning, but basically that was the bootcamp condensed into an hour, wasn't it? Morning, Tom. What fib level? What are the fib settings you're using? Just normal. My fibs just normal, I think. 23, 38, 50, 61.8, and 71.9. I don't even know what the normal fibs are. Those are the ones I always use. I think I'm pretty sure they're just the standard fibs, aren't they? I don't know. I don't use anything special. Oh, and again, fib levels. Don't get hung up on which ones, right? When you have a market structure movement, it starts from somewhere and it moves. If you're going to go into a market structure long move, it will pull back a distance and then it will move up. That, I don't know what it's going to be, but typically you find it moves roughly a third, a half, or 3/4. So the 23 is kind of out. I class that as a flag. So if I get a 23 pullback on a fib, I class it as a flag break. If it pulls back to 38, yeah, that's roughly a third. That is what I would class as a standard profit take move before they continue a next leg. If it pulls back 50% of the move, that's a pretty decent pullback. If it pulls back 61.8 to 71.9, roughly 3/4, that's a deep pullback. If it goes any lower than that, it's an A-shaped recovery. And an A-shaped recovery is part of a range. But as for which fib levels you use, anything you like. But I would say pick whatever all you're doing is you're segregating a movement into pieces. Think of it like a cake. Yeah. That's half a cake. That's a quarter of a cake. That's a bit less. Just split it into bits. Doesn't matter what you use because it's not going to hit it to the pip. It's not going to hit 38 to the pip. It's going to be somewhere around there on a shallow pullback. It's going to be somewhere around half on a medium pullback and somewhere around 61.8 to 71.9. Yeah, which is a whole 10% variance, somewhere around there on a deep pullback. Don't get exact because you can't be exact on something that isn't exact. The exact pullback on this move here. So we've basically had a push down and a pullback and a drop. Yeah, what is it? Don't know. It's 49. But it's 50, isn't it? It's roughly pullback half. Don't just, this is the whole mechanical thing. If you try and build an EA to trade Fibonacci retracements, you will be telling the EA when it pulls back to 50%, take a long. What if the market pulls back to 49.6? You're not going to take a long. You get a lovely bullish engulfing, or you get a lovely hammer put in at 49.6. You're not going to take it. Eh? The EA certainly won't because you haven't told it to, because you told it to take it at 50. But that's probably going to pull back and rally, isn't it? You've got to be in front of the charts. If you want to trade as a job, you've got to be doing the job. The job is to analyze what's going on. I see a whacking great tail at a level of support. That tells me that the sellers tried to rally. The buyers triggered their limits here and pushed them all back. It's bullish. Doesn't tell me if it's going to continue, but it tells me what happened in that period of time. And when you've seen it happen so many times in the past, like there 3 times, yeah, those are shorts off of a double top. Yeah, but so many people are going, no, it's not. Look, it went miles through it. No, it's not. It went miles through it. No, it's not. It's a double top. Just because the limit orders triggered a little bit further up there than a little bit further up there doesn't mean it's not a triple top bounce. It is. But then all these smart money traders will be telling you that's a liquidity run. And that's a liquidity run on that liquidity there. And that's a liquidity run on that liquidity there. Yes, it is all a triple top bounce, roughly in the same spot. Call it what you like. At the end of the day, it's a load of banks executing orders at a level where they previously executed orders because they're short. That should tell you don't want to be buying it. And if you trade long enough and you watch charts for 5,000 hours, day in, day out for 5 years, you'll know what that means. And you'll know it's not going to happen at exactly the same level every time, because it never does and it never will. This double bottom bounce here, no one will call a double bottom bounce because that's the double bottom bounce. That is still a double bottom bounce. Look, it bounced, it rejected and bounced. That's a double bottom bounce. M patterns, W patterns, not exact. There's a beautiful W there. Most people won't see it because it's, and again, it's all completely discretionary. There's a lovely M pattern reversal there. Yeah. But, you know, there's nothing in this industry you can pick that is ever going to give you confidence to say this works X% of the time. Because if you backtest something, you get a 50% strike rate. When you forward test it, you won't get a 50% strike rate because what you backtested will never happen again. Which is why I say, you know, backtest as much as you like with the ORB EA, but you won't beat my backtest results. My backtest results are conclusive that they make money. The strategy makes money over a period of time. It's going to have hideous weeks, months, and it's going to go sideways for ages. But over a long period of time, if you just hit the long and the short button with a positive R when the market is going mental, that's the edge. That is literally as simple as that. That's why ORB works. But that's also why you're not going to pass prop with it all the time. Because when it doesn't work, it's not going to work. My strategy is straight up gambling. Praying for oil to rise. It's all gambling. It's all gambling. It's exactly the same as going into a casino. Yeah. If I press the buy, I've got an option right now. I can do one of two things. It's binary. I can either hit that button or I can hit that button. If I hit the button on the left, I'm betting it goes down. If I hit the button on the right, I'm betting it goes up. What's my risk? Well, that's where it differs from gambling, because I can determine the distance of risk and I can determine the amount of money I risk. In gambling, you can only determine the amount of money. In trading, you can not only determine the amount of money, but you can determine the variance on your risk. Big difference. That gives us an edge that the casinos don't have. Imagine if you walked into a casino and said, I want to play blackjack. And they go, yeah, no problem. Or I want to play roulette. And I'm going to go black or red. And they go, yeah, no problem at all. But what I want to do is I want to predict whether there'll be more or less than a 50% reds or blacks in 15 spins. Casino go, no. Because their edge is that green's going to turn up at some point and you're going to lose your money. If you put the variance in your favor by adjusting the conditions, you can benefit from it. That's all trading is. It's looking for a set number of things that happen over a period of time that you can control and you can get an edge out of. And if you're wrong, a way to not lose money on those edges more often. I've listened to that ad. Same as the order flow guy, Mr. Barclays, Michael. Yeah. So that's Nirav from G7FX with our useless retail charts, as Brian's just said. But that's the thing about Nirav. Yeah. He sells a course that teaches you how to trade inside of candlesticks. Yeah. He says that candlesticks are useless retail charts. And then he shows you his system, which is basically painting numbers inside of candlesticks. It's the same thing. Every time he has a number here that says 800, and then the numbers around it say 500 and 200, that is the point of controlling that 5-minute candle. Does that give you an edge as to whether the market goes up or down next? No. All it does is it gives you a level within a useless retail candlestick that he anticipates price is more likely to move at. The odds of when you press that button are exactly the same, whether you're using inside candlesticks, you're using order flow, you're using delta divergence, using the RSI, a moving average, a reversal. It doesn't matter what you use. The odds are the same. Gambling. It's not gambling, it's calculated risk taking, is what it is, isn't it? Wayne, I haven't looked at the settings or tested the market reverse alerts EA yet, so I'm asking, does the EA have settings for the CCI? No. No. It's RSI only. I've traded the CCI, and yeah, you could use a CCI. So Use anything you like, but they're all going to do the same thing. You won't get a better result with the CCI than you will with the RSI. I've tested every oscillator under the sun pretty much. So, Philip, if you're wrong, just double the bet. Exactly, and that's martingale. Everybody at some point in their trading career goes down the martingale route. Everybody will. No one will go there again, because you will get martingale. And I think probably out of all strategies or all risk strategies, martingale is the one that everybody actually loses real money on. Everybody does lots of demo trading. Everybody does lots of trading with real money, and you kind of flow in and out of the trading on demo. Then I'm going to go live and with real money. Then you lose your money and you go back to demo. Then you go back to live, you lose your money and you go back to demo. Everybody blows accounts over and over again. Everybody always blows on martingale, because you will always find a martingale strategy that works, and you will back test it for a year and it works and it's brilliant. But you will then forward test it and it will fail, because you suddenly realize that within 8 trades, you're virtually at blowing your account point. Even if you start at 0.01, after 8 trades, it doesn't matter what your account size is. You start with a 0.01, you're then trading a 0.02, then a 4, then an 8, then a 16, then a 32, then a 64. Before you know it, you're at 1+ lot, with all this lot also having either been in drawdown, open currently, or have created a loss on your account, meaning that is almost a margin call. That's what you don't take into account. The fact that you've just lost 25% of your account by trying to get back the losses. Now you're going in with one lot, your margin call is going to happen very, very fast. And as soon as that margin call happens, they'll close that trade and that's your account gone. Doesn't do that in backtesting. It just doesn't work. Martingale is utter suicide. Hybrid martingale, which is kind of what I cover in the bootcamp, that's fine, but only because you are constantly taking losses on it. So if you're going to use a hybrid martingale where you get in with a 0.01 and then you get in with a 0.02 and then a 0.04, if the market has moved a certain distance away from you, you close that and take a loss so that isn't going into drawdown. Or you close half of that out, so that now becomes a 0.01. Adjust. But if you just literally pile up double every time, you will blow your account every time. Again, opening range breakout strategy. So many people have contacted me saying, well, why don't you just go long with 1? And then if that doesn't work, go short with 2. If that doesn't work, go long with 4. Surely the market can't do that all day. And I've built the model to do it. And it works beautifully for months. And then it hits one day where it just goes bang, all gone. Because the market did do that all day. Because the market will do what the hell the market wants to do, because you can't control it. And there will be a day that will happen. Always. Daily candlestick charts. The slowest possible thing in the world. You would think that there's no chance of you ever getting into a situation where you can't get out of a daily position trade if you're just trading daily candlesticks. Tried it. There are days. And it doesn't matter. At the end of the day, it's your money on the table. So at some point you'll lose it. If you continue martingaling, it just doesn't work. But in a casino, it works. And the reason it works, and this is why people do it, because it's a betting strategy. It was developed by the Chinese for blackjack. Martingale, it was developed for blackjack because blackjack has a decreasing variable, which is the number of cards. So the longer you play blackjack, the higher the odds of you catching a winner are, because there are cards in there. The pack of cards, the 7 packs of cards in a blackjack deck, the number of 10s and aces, and the way that the cards come out with that 17 being the sticking point, you will always have a run where you will get a winner within a certain period of time. So as the game goes on, the variable odds of you winning increase. That's why martingale can work in blackjack, but you've still got to have a hell of a big bank balance to make it work. It doesn't work in trading because there's no decreasing variable. If the market wants to do that for 6 months, because a fundamental has meant that there is no advantage between two currencies, the market will do that for 6 months. Even if it's never done it ever in the past, there is no variable decreasing that forces the market to do anything different than do what it wants to do. Totally different thing when you're playing a game. But everybody tries to apply, there's about 4 or 5 different strategies, betting or gambling strategies that are well-known trading risk strategies, and they all work to a certain extent for a certain period of time until they don't. But you know, that's when it all goes horribly wrong. So you have to get out at some point. You got to pick a point and go, nope, dead. This trade is dead. Aussie New Zealand, and that's the beauty of the market reversal alert CA, in the fact if you want to set it up like this, and it is good to do. I'm becoming more and more of a fan of it now. I've started using it. Scale out on the way. If you're constantly scaling out of your position, you're constantly keeping that average closer. So the way I used to do it, and the way I kind of teach in the bootcamp, is to teach to do drawdown control when something gets to a certain level. Do some drawdown control on it. But actually, it's better to just do drawdown control on the way, I think, because if you're in a position, it's better to scale out of that size faster, because it makes the pain less. And you know, things like this where we're getting like 6 weeks or 4 weeks solid like this, they just don't happen very often. And those are them, you know. But I came out of this, didn't I, with we looked at it last week, a 1% loss. So the Aussie New Zealand for 6 weeks, that entire trade, I made 1% loss. Just, you know, but I've got no qualms about, I'm not bothered. I enter the trades. It doesn't matter, because you're not risking too much. And going back to what we were talking about earlier with the trying to find a tip or a trick to stop you getting worried about taking a trade. Risk. You are putting money in the market. If you're worried about the amount of money you put in the market, you're over leveraged. If you're over leveraged, reduce your risk to the point where you don't care. If you hit the button, now, I couldn't care if that goes long or short. If it goes short, I'm going to make some money. If it goes long, I'll do it again, and I'll do it again, and I'll do it again until it goes short. Because that's what it does. That's what it's always done, and that's what it will always do. It'll go up and it'll go down. All I've got to do is wait, because the banks can't sustain that. They have to do that. If they don't do that, they don't make money. What do banks do constantly? Make money. They will always do that. You just got to ride it out. That's the job. Not finding the system or strategy with the perfect strike rate or mechanical entry rules. Are you in positions on GJ? Yes. There's 4 on that at the moment. I'm actually in this trade as well. So this is pretty much what I'm on. Also Aussie yen, but I'm out of that now. I'm out of Aussie yen there, but the EA is still in it from squeeze on the Aussie. But, you know, the intervention side of things, you know, again, the target is there because of the propulsion gap. That is, I reckon, probably the most likely propulsion gap there. So that is where I reckon is probably where we will get to. If the Japanese intervene, obviously, it's going to be down at the monthly lows. But if they don't, I think we can do a good 2 or 3 ADR today. Not today, this week. But, you know, again, what do you need? Always got to ask yourself when you're in a position, what do you need? So if a position has gone against you and it's cost you 1.3% on scale outs, if that's 2.2%, yeah, it's taken weeks, but there's 1% in the bank. If you're looking to make 10% a month, you've only got to do 10 positions a month, haven't you? It's all down to just getting in and getting out, and don't worry about the money. Don't worry about anything. Just worry about what the market is doing and worry about exiting your positions when they get into a position of profit, because you are always going to go into drawdown on everything virtually. There's very little, like this euro US dollar that's just been taken. Yeah. This could well easily go into drawdown today. It might just go up to there and hit that TP. And if it does, that is absolutely beautiful. But how many times does that happen where you get into a position, it just works? You know, it's rare. Most trades, there's one there, short, straight in, straight out. There's a short there, straight in, straight out. There's a short there, straight in, straight out. There's a short there that I exited because it went sideways for 4 days, but that would have been part of a 2-trade entry and exit. You know, most of the time that doesn't happen. Most of the time we're taking multiples. And most of the time we're getting out too early. The reason that exit was there was because of that propulsion gap. Besides that propulsion gap, not a coincidence that I got out there, because the last time they tested that propulsion gap, they added to the sells. So if they're going to test it again and we're going to move into a range, my brain is thinking that's where we're going to get to before we drop. I have no idea. And obviously, if I could see into the future, I would not have exited there. I would be still in it, but I can't see into the future. All these propulsion gaps to the upside may or may not have got filled. They all have got filled. That propulsion gap down there may or may not get filled. But if you're going to short it, there's a high probability of that, or that happening. Which of those are you going to go for? You. But we know that if that propulsion gap gets filled, there's nothing but downside targets. Why? Because the market's been moving up. After it's finished moving up, it then has to move down to take profit. So these are telling you where roughly we might find support, where they're going to add back into their positions. And you will usually find these fall within fib levels as well. 50% retracement, propulsion gap, 61.8, 71.9, propulsion gap, 38. There's always going to be a propulsion gap around a fib level. So if you're thinking, right, we're going to do a flag break, that's your 23, there's your propulsion gap target. If you're thinking we're going to do a shallow pullback, you use a 38. If you're thinking we're going to do a deep or medium pullback, using 50 to 61.8 propulsion gaps. But always use a gap, because a gap is where the market goes to, as this chart obviously just shows again and again and again. Yeah, every propulsion gap has been filled apart from that one. So today, if you're a buyer, buy it up to there. If you're going to sell it today, assume that if it doesn't do that today, you're going to need to get another one on, because that's what the market does. Just finding patterns. Everything plays out, but nothing plays out with any certainty in any shape or form. So you remove the certainty. You don't need to worry about how you get in. You need to worry about what you do after you get in, because we can't time it. So stop trying to time it, just get in and then worry about it after. But pick a reason to get in. And if you want to use the CCI, as somebody said today, and don't use the RSI, use the CCI. Use any oscillator you like to measure market movement up and down. It's just a condition. We just need a condition indicator to tell us that there's been a movement. But you don't even need that. If you don't want to use that, don't use that. Just use ADR. You could use ADR extensions, so you could literally draw boxes or something and say, right, we've just broken a low. So an ADR on this is 124. There. So that's an ADR roughly there. So as we've broken that low there, if it moves down, what are you doing? If it moves down 3 ADR and they haven't pulled back at least one ADR, i.e. if it just goes like this down to here and it hasn't done that, I will get in. You could use that as a rule. Doesn't matter what rule you do. And as I said, in the position trading bootcamp, you can use that methodology, the position trading methodology, in any system or strategy that is based on mean reversion. This thing got all the way down to there, pre-ADR from that break, where it created that propulsion gap, and it didn't pull back once. It just pushed, went sideways, pushed, went sideways, pushed, carried on pushing. So that's my trigger point. And I'm pretty sure you'll find something like the RSI. You can't see it because my head's in the way. But the RSI is extended, because the RSI is, the reason I use the RSI is because it's measuring the relative strength of the two currencies. So it's telling me that there's been too much relative strength in one direction without a pullback, because if there was a pullback, it would have been close up into the mean of the RSI. That's why I use the RSI, not the CCI, the stochastic, the MACD, whatever, because this is measuring strength, and I'm interested in strong moves that the banks haven't taken profit on, so that I know that they're ready to do that. That's why I settled on that, and that's why that I think it's the best one to use. But it's, doesn't matter. Use what you want to use. There's no right or wrong in anything to do with trading. It's literally a coin flip as to what you use. So if you want to use CCI, but it's not built into the market reversal alert CA, that uses the RSI, because I found that to be more effective in my testing. But doesn't mean my testing is the right thing, does it? Right. So if you took that DAX bounce, well done. You are now back down there. And where did I say would be the best place to take profit? Where it bounced last time, because this is where we're likely to see orders trigger, because that's where they triggered last time. So I mean, I have no clue, but logically, knowing how the banks operate, that's likely what they will do. We will find a profit take move, or we will find a batch of people wanting to buy it down here, because that's what we found last time we got here. Whether it'll work or not, I don't know. But if you shorted it from there or from there, that's probably 1.5 hour. That's a good trade. Yeah. Right. Anybody got any other pairs they want to look at? Now I've stopped waffling. Is anybody still here? Oh my God, there is 80 people. Glutton for punishment on a Monday morning, you lot. Right. So news today, obviously we haven't got a lot. We've got, that's come out at 9 o'clock. We've got Jordan speaking now. So just be aware, Tesla shares down 2.1% pre-market after Golden. So Tesla might be part of that sell-off that we saw. That might be part of it. When you get a large stock drop like Tesla, that will have a knock-on effect on all stock in that sector. So there's multiple sectors impacted there. So you've got the motor sector will be impacted. You've got the electronics sector will also be impacted by that, because all the companies that manufacture electronics for Tesla will also have a knock-on effect on their stock prices, because it's all interlinked. So that's why when I talk about sector sell-offs, that's the type of thing that's happening. So that's probably what happened this morning and why we've got that big initial drop. So this is basically Tesla bringing the market down by the looks of things. So it isn't related necessarily to the yen or to what's happened in Ukraine. This is why you need to keep an eye on the news, so you can try and figure out what's going on. So yeah, just keep an eye on the news for Jordan this morning. Very tight-lipped, the Swiss National Bank, but if there is going to be something said important, we know it. Other than that, we've got Lagarde speaking, so there's no other news to worry about today. So today should be just kind of business as usual. So any ADR reversals, if we do hit ADR today, there's no fundamental reason for it, so they're probably good little reversals to take today, scalped. Other than that, it's just a case of waiting for stuff to happen. So all the yens are coming down very nicely at the moment. So we are getting that yen strength starting to show through. Reverse alerts just about to trigger on the hourlies. So market structure, very pretty M, is it? But it's, you know, it's all starting to roll over. So we will see if we get any big movement, or whether we just get a little bit of a rally down on everything, i.e. yen strength. So all going in the right directions, but we will see. So I'll be back this afternoon at 2:20. We'll obviously look at the New York session and see what's going to go on with the indices there. Same thing with the indexes, obviously opening range breakouts. We've got quite a lot of movement put in. If the DAX does drop, it's a fair old way away, but I mean, there is, we've done half an ADR, so there's potential we might get some ADRs on the indices before the market opens, but that's going to need the DAX to come out of these lows. And as we saw, if the DAX does come out of these lows, there's nowhere for it to go today, apart from down to monthly, which is 175 ADR. Yeah, so we'll be looking for some of 150, 175 ADR if it does break that low. And that's where we'll expect to see the next batch of limits trigger. So if we do, there's plenty of movement still on the DAX to the downside. That will drag the US indices down. That will get them to ADR. So longs in New York potentially this afternoon. We'll see where they take it at the open. But yeah, no news to affect it. So I'll be back at 2:20. We'll have a look at that. Anything else you need, let me know. I'll be in Telegram as usual. And yeah, if I don't see you before, I will see you this afternoon. If not, back tomorrow morning, 7:50. All right. Have a good day.